In this section, we're going to cover the corporate income tax. We're going to talk about the formula and then just some special rules relative to corporations in calculating that tax. So first, the formula. You'll see that this has some similarities to the individual income tax formula, but also some differences. We start with gross income, same definition as before when we learned about individual income tax gross income definition. All income from whatever source derived, unless we see some other reason to exclude it. We subtract deductions and losses. We arrive at taxable income before special deductions, subtract special deductions. We arrive at taxable income, multiply that by the tax rate. Remember this year it's a flat 21%. Then we get the tax due before any credits or other taxes. We'd subtract any applicable tax credits, add back any personal holding company tax, accumulated earnings tax, or other special taxes to arrive at our tax liability, and from there we'd subtract the estimated tax payments we'd made throughout the year to arrive at our net tax due or refund owed. So corporations have to make some elections. They have to elect the tax year. They generally can use a calendar year or a fiscal year. A calendar year will end on December 31. A fiscal year will end on another day at the end of the month during the year. You select this when you file your first tax return. The first tax year may be what we call a short year. It may not cover 12 months. In that case, we would annualize our income. And the tax year must coincide with the tax year for financial accounting purposes. So financial accounting and income tax accounting tax years should coincide. There are some restrictions. An S corporation and a personal service corporation can generally only select a calendar year as their tax year end. Corporations also have to select their accounting method. The accrual method of accounting is what is required for corporations unless an exception applies. The first exception is a farming business, also a personal service corporation, which that is when substantially all the activities performed in the corporation involve the performance of services in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting, and substantially all the stock is held by current or retired employees performing those services. There's also an exception for the 25 million gross receipts test, and this means that the average gross receipts for the 3 immediately preceding years are not greater than $23 million. And finally, S corporations also do not have to use the accrual method of accounting. One other method of accounting is the cash method of accounting, which we're probably familiar with. And then finally, the hybrid method of accounting, which would use the accrual method for sales, cost of goods sold, inventories, accounts receivable, and accounts payable, but would use the cash method for all other income items and expense items. This graphic is in your book, and this slide shows some of the major differences between individual income tax rules and corporate income tax rules. So the first is gross income. That's generally the same definition like we said. This slide mentions exclusions available to individuals but not to corporations, and vice versa. But remember, gross income is all income from whatever source derived unless you find an exclusion in the code. So that's the same definition. Number 2 is deductions. Individuals have above-the-line deductions for AGI and itemized deductions. Corporations don't have that. They don't compute AGI. And their deductions are presumed to be ordinary and necessary business expenses. For charitable contributions, the calculation of the amount is generally the same. There's a few differences, but the limits are different. So remember, individuals were limited to 60% of their AGI for cash, and that limit went down depending on what type of property. So it could be 50, 30, 20. For corporations, their limit is 10% of taxable income, and that taxable income is adjusted for certain deduction items, which we will talk about in later slides. The fourth is depreciation on Section 1250 property. So if you will think back, individuals usually don't recapture depreciation under the maker's rules because that's straight line depreciation that happens on 1250 property. But corporations have to recapture 20% of the amount that would be recaptured under Section 1245. Individuals are subject to a 25% tax rate on unrecaptured 1250 gains. Corporations are not subject to that. On net capital gains. So for individuals, remember we had capital gains tax rate for long-term capital gains. It was a preferential tax rate. For corporations, their corporate capital gains are taxed at the same regular corporate tax rates. And that came into place because of the Tax Cuts and Jobs Act. Everything is taxed at 21%. For capital losses, if you think back, individuals can deduct up to $3,000 of net capital losses against ordinary income. Remember, first we use capital losses to offset capital gains, and then beyond that, they were allowed to deduct $3,000 against ordinary income. Corporations cannot do that. They cannot deduct any capital losses against ordinary income. So if they have capital losses and excessive capital gains, they can carry those back 3 years and forward 5 years. And 7, they have a dividends received deduction. This is not available to individuals. We're going to talk about this in this set of slides, but generally this deduction is there to combat the double taxation problem. Number 8, net operating losses. Net operating losses for individuals had a lot of adjustments to the negative taxable income. We added back a lot of different things. For corporations, a net operating loss is just the excess of its deductions over its income for the year. They carry over indefinitely if they were incurred in tax years beginning after 2017, but there's a limit. So net operating losses are subject to an 80% of taxable income limitation for corporations. Number 9, for tax years beginning after 2017, a limitation on excess business losses applies to non-corporate taxpayers but not C corporations. And then the tax rates we've talked about, but the corporate tax rate is now a flat 21% rate. We know for individuals the rates are progressive. The alternative minimum tax is not applicable to corporations anymore. It's repealed. Passive losses, those rules are going to apply to individuals, partners, S corps, and closely held C corps and personal service corps, but they don't apply to widely held C corporations. And then casualty losses are going to be deductible in full by a corporation because they're all business losses. We had all those weird rules for individuals, remember, and for investments, but for our case in this course, all casualty losses are business losses. They can be deductible only if attributable to, for individuals, they're deductible only if attributable to a federally declared disaster. And there's still an exception for casualty losses to the extent of casualty gain. So let's look at our first problem, problem 3-47. We have Western Corporation reporting the following results for the current year. And in A, we want to know Western's taxable income and income tax liability for the current year. And then in part B, we're going to change it a little bit. So we have gross profit on sales. We have long-term capital asset transactions and short-term capital asset transactions, and we also have operating expenses. With the capital asset transactions, just like we did for individuals, we're going to net the long terms and net the short terms. So when we do that, over on the right side of my sheet, you can see this netting. Netting the long terms, we ended up with a long-term capital loss. And when I netted the short terms, we ended up with an $8,000 short-term capital gain. So I net those two together, and I end up with a $1,000 net capital gain. And for corporations, remember, capital gains, whether long-term or short-term, do not receive a preferential tax rate. So they're taxed at 21% either way. So this $1,000 net short-term capital gain is going to be part of income. So when I look back to the left, when I'm calculating my tax due, I start with gross income. And those items of gross income in this problem included gross profit on sales of $150,000 and that $1,000 net capital gain I just calculated to get my total gross income of $151,000. From there, I'd subtract deductions and losses. In this problem, the only deduction and loss I have is the $61,000 of operating expenses. So I subtract that. I arrive at taxable income of $90,000. I don't have any other things in this problem. I don't have special deductions. I don't have any credits and other taxes. So I arrive at my taxable income of $90,000, and I calculate my tax liability by taking 21% of that. So $90,000 times 21% is $18,900. In Part B, it asks us how the answers to Part A would change if Western short-term capital loss is $5,000 instead of $2,000. So that's going to affect our netting, right? Remember, we netted the long terms and we netted the short terms. So here in Part B, we can see it would change the short term. So when I net these short terms together, I end up with a $5,000 gain on my short-term capital gain. So remember, I had a long-term capital loss of $7,000. That didn't change. So I had a long-term capital loss of $7,000, short-term capital gain of $5,000. When I net those two together, I end up with a $2,000 long-term capital loss. Remember, this is corporate income, and in corporate taxable income, I can't offset any ordinary income with a capital loss. So that $2,000 long-term capital loss I can carry back 3 years and forward 5. All right, so that's going to change. That would also affect my tax liability because in my total income, I wouldn't have that net capital gain anymore. So my total income would only be $150,000. All right, and this problem, we have Gamma Corporation. They sold the following property on March 3rd of the current year. They sold securities, equipment, building, and land. The corporation used the equipment, building, and land in its businesses and had held all the property more than a year. Aside from these transactions, Gamma had $720,000 of operating net income during the current year. And Gamma has a $24,000 non-recaptured Section 1231 loss from prior years. Determine the character of the gains and losses and calculate the corporation's taxable income. Okay, so on equipment and building, you see we've been depreciating these. And so we're going to have to deal with depreciation recapture under Section 1231. If you think back, 1231 allows preferential tax treatment for gains and losses, but we have to recapture that depreciation in years that we sell the asset. So equipment and building are going to have that depreciation recapture. Okay, so in this problem, the way I did the answer was I took the sales of assets asset by asset. So first I dealt with the securities, then the equipment, then the building, and the land. So for the securities, they sold for $65,000 and their adjusted basis was $100,000. And it gives you the gain here or loss in the case of the securities. And remember, we calculated that by the amount receivable minus the adjusted basis. The amount received minus the adjusted basis. For the securities, that's a $35,000 loss. And you can see that in my section here. It's a long-term capital loss because these are investments. So they're capital assets. So we have a long-term capital loss of $35,000. Going back to equipment, it's sold for $210,000. My amount realized was $210,000, and my adjusted basis was $75,000. They didn't have to give you that, right? Because we know how to calculate adjusted basis. We calculate it by taking cost minus accumulated depreciation. So when I take amount realized minus adjusted basis, I get a gain of $135,000. Now, that gain is going to be part recapture and part 1231 gain. So remember, we need to recapture. If this was an individual, we would recapture as ordinary income the portion of that gain that was attributable to depreciation taken. So I had a gain of $135,000, but on the equipment you can see I only took $125,000 of depreciation. So of that gain, $125,000 is recapture and $10,000 is 1231 gain. All right, let's look at the building. So we had a building, we sold it for $385. The adjusted basis is $280. I took $120,000 of depreciation. So the building has a gain of $105,000. Of that $105,000, we need to split it between 1231 and recapture. So remember, for a building, 1245 recapture is going to be the lesser of the accumulated depreciation or the gain, just like before, so that we took $120,000 of accumulated depreciation, but the gain was only $105. So I only have to recapture $105. Now for corporations, Section 291 is going to require a recapture of 20% of the amount of the gain attributable to depreciation. So in this problem, it's 20% of that $105,000. So of the $105,000 gain, $84,000 is going to be 1231 gain, and $21,000 is going to be Section 291 recapture. And then the land, the amount realized was $175. The adjusted basis is $190. Of course, we don't have any depreciation on land, so we have a $15,000 1231 loss. Now that we have dealt with each of these items, these asset sales individually, we can compute our taxable income. So we have income from operations. Remember, that was in the problem. In the last paragraph, it says, aside from these transactions, Gamma has $720,000 of operating net income during the year. It also has a $24,000 non-recaptured 1231 loss from prior years. So again, if you think back to Section 1231, it allows preferential treatment for 1231 gains, but we have to recapture losses over the past years. Okay, so this year we had $720,000 income from operations. We also had some ordinary income from recapture. We had $125,000 from the equipment and $21,000 from the building, so that's $146,000. We also had some ordinary income recapture from the look-back rule. So it was that $24,000 non-recaptured 1231 loss. I'm recapturing it this year. All right, so this is all my ordinary income. I also then need to net all my 1231 gain income. So I had $10,000 1231 gain from the equipment, an $84,000 1231 gain from the building, and a $15,000 1231 loss from the land. All right, so when I net that together, it's $55,000. Then I also had to subtract my long-term capital loss from the securities of $35,000 to end up with a net $20,000 capital loss. Because remember, 1231 allows us to treat gains as capital gains and losses as ordinary. So that's why we're netting those two together. That net 1231 gain is treated as a capital gain, and then we had the capital loss from the securities. So when I add all of that together, I get taxable income of $910,000. Now, this may seem irrelevant now because our tax rate is 21% across the board, and capital gains are not taxed at a preferential rate. So all of this calculation doesn't really make a huge difference in my taxable income dollar amount for 2018. And it doesn't make a difference in the amount of tax I pay for 2018 because everything is taxed at 21%. But before this, long-term capital gains had a preferential tax rate for corporations, and they may after this. So this is an important exercise to know how to do, even though it doesn't have a lot of relevance in 2018. Okay, so moving on to business expenses. These are when we were thinking about our tax formula, we had gross income and then we subtracted deductions and losses. So these business expenses are going to fall into that deductions and losses section. The first one is just ordinary and necessary business expenses are deductible. So you have covered those before in your individual income tax course. Same thing. Ordinary and necessary business expenses are deductible. They have to meet all of those criteria. Ordinary, necessary, reasonable in amount, all of those things. Another thing that's deductible as a business expense is organizational expenses. So these are generally capitalized and amortized over 180 months. However, Section 248 allows the first $5,000 to be deducted unless the organization expenses exceed $50,000. The amount of immediate deductibility is reduced dollar for dollar by the amount of organization expenses exceeding $50,000. If it's not immediately deductible, it can be amortized. So if my organizational expenses were $50,002, then my immediate deductibility would be reduced by 2. So it would be $4,998. And then the rest would be amortized over 180 months. Section 248 is elective, but it's deemed elected unless the corporation opts out. So these are things like accounting, legal, temporary director fees, filing fees, things like that to organize your business. Another common expenditure we see when we're beginning a business is startup expenses. And these are ordinary and necessary business expenses paid or incurred by an individual or corporate taxpayer to investigate the creation or acquisition of an active trade or business, to create an active trade or business, and to conduct an activity engaged in for profit or for the production of income before the time the activity becomes an active trade or business. So in this one, we kind of draw a line in the sand between when I'm starting the business and when the business starts. So things I pay before I start the business that fall into this category would be startup expenses, but after I start the business, they're probably just expenses. These have the same treatment as organizational expenses. It's found in Section 195, and it allows the first $5,000 to be deducted unless the organization expenses exceed $50,000. And the amount of immediate deductibility is again reduced dollar for dollar by the amount of organization expenses exceeding $50,000. All amounts not immediately deductible can be amortized over 180 months. And again, this is elective, but it's deemed elected unless you opt out. Here we have Delta Corporation. They incorporated on January 7th, began business on July 10th, and they elected to have its initial tax year ending on October 31. Delta incurs the following expenses between January and October related to its organization during the year. And before we go through these, I want to look back and look at the line in the sand, right? We said that these startup expenses are amortized over 180 months, and these occur before business starts. So the line in the sand here is July. July 10th is when they actually began business. So let's talk through these expenses and see in what category they fall. On January 30th, they traveled to investigate a potential business site. That cost $2,000. That's a startup expense. On May 15th, they had legal expenses to draft the corporate charter. That's an organizational expense. On May 30th, they paid commissions to stockbrokers for issuing and selling stock. This is not a startup or organizational expense. This is a reduction of capital. All right, so we paid a commission, and that's going to reduce the amount of paid-in capital. On May 30th, we also paid temporary director's fees of $2,500. That is going to be an organizational expense. On June 1, we paid an expense of transferring the building to Delta. So again, this is not an organization or startup expense. This is going to be capitalized as the cost of the building. We are going to capitalize everything that we pay to buy the building and get it legally in our name. This is in that. On June 5th, we paid accounting fees to set up corporate books. That's an organization expense. On June 10th, we paid training expenses for employees, $5,000. That's a startup expense. It is a startup expense because we have not yet begun business. If we had already begun business and we paid training fees, that would just be salaries and wages expense. On June 15th, we paid rent expense for June of $1,000. That's a startup expense. Again, we have not begun our operations yet. On July 15th, when I pay rent expense for July, that's going to be just a normal, ordinary, necessary, reasonable Section 162 business expense. It's just going to be deductible because I've already begun operations. So now looking at the problem in Part A, what alternative treatments are available for Delta's expenditures? All right, so Part A, I can choose to deduct up to $5,000 of organization expenses and amortize the rest over 180 months. And I could also choose to deduct up to $5,000 startup expenses, amortize the remaining over 180 months. I could choose not to deduct that initial $5,000 in each category and just amortize them over 180 months. It's elective. Part B, what amount of organizational expenditures can Delta deduct on its first tax return for the fiscal year ending October 31st? All right, so we have to separate these in organization and startup expenses. We talked through what they are, and so I wrote them down here. The organizational expenditures are the legal fees, director's fees, and accounting fees. So $6,500 total of organization expenses. Remember, Section 248 allows us to expense $5,000 of those immediately. So in their first tax year ending October 31, they can expense $5,000. They can also amortize the rest, $1,500, over 180 months. 4 of those months have already passed. And so we started in July. So 4 months have passed. So for this first tax year, I can expense $5,033. Under Part C, what amount of startup costs can Delta deduct on its first tax return? So this is kind of the same thing. Remember, same treatment. So we talked through the startup costs. We had travel, training, and rent. So that adds up to $8,000. Business began in July. We can expense $5,000 immediately, and then we amortize the remaining $3,000 over 180 months. But 4 months of that have passed, July, August, September, October. So I can expense 4 of those 180 months this year, so $67. My startup expenses that I can expense this year are $5,067. All right, here we continue on our ordinary deductions, our business expenses, our deductions and losses. We can obviously deduct compensation we pay to employees. If we have accrued compensation, that means we owe it, but we haven't yet paid it. When we have that, we must make the payment within 2.5 months of the accrual. Otherwise, they're going to be treated as deferred comp, and they're not going to be deductible until paid. We also can generally deduct interest. That's an ordinary, necessary, reasonable expense. But we have a limit here. Net business interest is going to be limited to the sum of business interest income, 30% of adjusted taxable income, and floor plan financing interest for motor vehicles. We're not going to focus on that third one very much. Business interest income is only income from the business. It's not going to include investment interest. And business income is not going to include investment income. So when we're looking at 30% of adjusted taxable income, it's going to be taxable income not including income, gain, deduction, or loss that's not allocated to the trade or business, so investment. And it's not going to include business interest or business interest income in there. Another expense that we used to be able to deduct as a ordinary deduction and loss is entertainment. That's disallowed. I'm no longer allowed to deduct that. And then executive compensation. Again, compensation is deductible, but we have a limit on deductibility beyond $1 million for covered employees. And covered employees are defined as the CEO, the CFO, and the 3 highest paid corporate officers. We also are allowed a deduction for charitable contributions. And we have to measure that deduction. It's easy if it's cash, $100 is $100, but we have to measure that deduction if we're contributing property. And most of these rules mirror that deduction for individuals. So if I contribute capital gain property, the treatment is going to be mirrored here. So the charitable contribution, it's deductible when paid, but there's an exception for an accrual method C corporation taxpayer. In that case, it's deductible in the year accrued if it's authorized, the board authorizes it in the year accrued, and it's paid by the 15th day of the 4th month after the year of accrual. So if you remember, that coincides with the day I have to file my tax return. I have to file my tax return by the 15th day of the 4th month after a year in, so I also have to make that contribution by that day. To measure it, it's measured generally as the fair market value of the property unless it's ordinary income property. So that might be inventory, something like that. Ordinary income property, the deduction would be limited to the fair market value minus a gain that would be recognized if sold. Usually that's the adjusted basis. There's an exception for inventory, and this is something you're not going to find in individual income tax. This is a corporate exception. So if I'm donating inventory, this exception would apply if the use of the property is related to the donee's exempt function and it's used solely for the care of the ill, needy, or infants. That property is not transferred to the donee in exchange for money, other property, or services, and the donee receives a statement from the charitable organization stating that 1 and 2 are true. That's the exception. If the exception applies, the deduction that I get to take for that charitable contribution equals the adjusted basis plus half the gain that would have been recognized if sold. So looking back, inventory is ordinary income property. So under the general definition, my deduction if I contribute ordinary income property is fair market value minus the gain that would have been recognized. This exception allows me to deduct a little bit more. It allows me to deduct the fair market value minus the gain that would be recognized, half of that amount, plus my basis. For capital gain property, the deduction is usually the fair market value of the property unless one of these 3 applies, and one of these 3 generally mirror my individual income tax rules. So, capital gain property, the deduction is generally fair market value unless the corporation donates a patent, copyright, trademark, trade name, trade secret, know-how, software, or other similar property. The corporation donates tangible personal property to a charitable organization, and the organization's use of the property is unrelated to its tax-exempt purpose, or a corporation donates appreciated property to certain private non-operating foundations. After we measure that contribution, the charitable contribution, we add all that up, we have a limit, and the limit is 10% of adjusted taxable income. And for charitable purposes, adjusted taxable income is defined as follows. It's the corporation's taxable income computed without regard to any of the following: the charitable contribution deduction, the dividends received deduction, or a capital loss carryback. And we will talk about the dividends received deduction later. But basically, I calculate my taxable income without including these 3 things. If my contribution is greater than this 10% of adjusted taxable income, I can carry the remainder forward for 5 years. If I don't use it within 5 years, it's lost. Here we have Yellow Corporation donating the following property to the state university. ABC Corporation stock, purchased 2 years ago for $18,000. The stock, which trades on a regional stock exchange, has a $25,000 fair market value on the contribution date. We have inventory with a $17,000 adjusted basis and a $22,000 fair market value. The state will use the inventory for scientific research that qualifies under the special 170E4 rules. And they have an antique vase purchased 2 years ago for $10,000, having an $18,000 fair market value. State University plans to sell the vase to obtain funds for educational purposes. Yellow Corporation's taxable income before any charitable contributions, deduction, or dividends received deduction is $300,000. And we want to know what the charitable contribution deduction for the current year is. Okay, so to do that, they didn't donate cash, they donated property. So we have to value the property. And thinking back to our rules, we need to decide what type of asset each of these items are in the hands of Yellow Corporation. So the ABC Corporation stock is an investment, and an investment asset is a capital asset. And generally, if I donate a capital asset, I can value that at the fair market value. So this ABC Corporation stock will be valued at the $25,000 fair market value. Inventory is an ordinary income asset. It is not a capital asset. So my general rule would tell me I would value that at the adjusted basis. However, there is that exception, remember, if they're going to use it for their charitable mission and Yellow Corporation didn't receive any compensation for that inventory, then I get to use that special rule, and we'll talk about what that means, but generally I'm going to value that between $17,000 and $22,000. And then finally, an antique vase. An antique vase is a capital asset, but it's also personal property. So this antique vase was purchased for $10,000 and it has a fair market value of $18,000. We know that for tangible personal property, that's a capital asset, I can value it at its fair market value unless the charity is going to use it for an unrelated use, and a use unrelated to its charitable mission. And we see here that's the case. We see State University is just going to sell it. So in that case, I have to value it at $10,000. All right, so here's what we talked about. We have stock. It's a capital asset. The basis is 18. The fair market value is 25. You can see over here under the deduction column, I'm going to value that at 25,000. We have inventory. It meets the inventory exemption. The use is related to the donee's exempt function. The donor did not receive money, services, etc. for it, and the charity issued a statement back to Yellow Corporation evidencing 1 and 2. So in that case, remember, I can deduct the adjusted basis plus half the gain that would have been reported had I sold it. So the gain, of course, would be calculated fair market value minus adjusted basis. I can add half of that back. So I can take a deduction of $19,500. And then the vase is unrelated use, tangible personal property, so I value that at $10,000. So when I add those three up, my total charitable contribution is $54,500. All right, but we know there's that limit. The limit is 10% of adjusted taxable income. And adjusted taxable income is taxable income without any charitable deduction from carryover from a previous year or this year, the dividends received deduction, and the capital loss carryback. They gave us that number in the problem. It said it's $300,000. So my limit is 10% of that. I am limited to a $30,000 charitable deduction this year. I can carry forward $24,500. I can carry that forward for 5 years.